basically chapter 4 and 5 and 6 talk about um, financial accounting, so financial statement analysis and financial forecasting. So the basic here is a review of accounting. So this is the chapter talking about three major financial statements. So first, let's look at the learning objective here. So the learning objective, three learning objective. One, explain how financial managers use the three basic accounting statements, the income statement, the balance sheet, and the statement of cash flow. Two, discuss how depreciation affects cash flow and compute depreciation expenses. Three, explain how the Tax Code and the Job Act of 2017 affected the way corporations are taxed. The annual report include income statement, balance sheet, statement of cash flow, and our company notes. So those are the major three financial statements, or we call them annual report. So the annual report are also called 10K form. It is 10K form. So the 10K form are required by SEC, Security Exchange Commission, and require all the public listed firm to report their 10K form. So let's say we have when you Google like Edgar is a database, okay, is a filing and a forms database required by the U.S. Security and Exchange Commission. So when you go to SEC, okay, Security Exchange Commission document, okay, look for that Edgar database. So we can find the company and person look up. So you can search any company you like and find their financial statement. The company financial statement is required to publicly list by the SEC. So the list is annual report. So every year you must file the financial statement. So let's say we look for a company, whatever the company you want, you can do. Let's say looking for Walmart. Okay, so you can search. When you see that, so you can type Walmart and you can see there are several information coming out. Okay. Okay, this is Walmart, right? Walmart, and we have the Walmart stores and Walmart Inc. Incorporate. So you have two CIK numbers. Okay. So you click on the CIK number. So you have all those different kind of forms. You have a 8K, and 10K form. So that's a 10Q form. 10Q form is a quarterly financial report, and 10K form is annual report. Okay. So you can find the forms you need. Let's say the 10K form is annual report, right? You have the annual report, and so you can see the documents. So you can see the 10K form, right? The 10K form here, all the documents. Okay, this is the 10K form is annual report. The annual report including the company's information and business background and the risk factors. And also you can see the most important is the financial statement and supplementary data. Item 8 is a consolidated financial statement. So financial statement include statement of income. So if you see there is a consolidate, more likely this company has overseas subsidiaries. The statement of income and the statement of comprehensive income and balance sheet, and also you have a statement of shareholders' equity and a consolidated statement of cash flow. Okay, so that's the major financial statement. And underneath this financial statement, you can see there are notes to consolidate financial statement. So the notes is also important because they have some information, important information about how the methodology, the accounting principle or methodology they used, and what are the changes, for example, the cash and the cash equivalent, and the receivables, inventories, what are the methods they used? They're using LIFO or they're using FIFO, right? And also they have how they do property depreciation and equipment. Is there any lease agreement? Okay, so you can see basically this is a 10K form. Okay, you might have to look at. So including income statement, balance sheet, and a statement of cash flow. So the first, let's look at the statement, the income statement. So the income statement is a statement over a particular period of time. Okay, so you can see here you have okay, you can see the income statement for the year ended December 31st. So that means the income statement is for that year, which is 2018, starting from January 1st until December 31st. This income statement is going to be organized like this. So you can see how they organize the income statement. And the first column is your sales. Okay, sometimes it's called a revenue. Okay, so the sales, total sales is the same like a revenue. Okay, so you have a total revenue. And then you minus your cost of goods sold. Okay, this is your minus. This is cost of goods sold. The cost of goods sold. So what do you mean cost of goods sold? So the cost of goods sold are direct cost. Okay, direct cost, and the cost of materials, and the cost of labor, and that is total revenue minus your cost of goods sold, and you have your gross profit. So the gross profit is the first items you need to look at. The company's gross profit is your total revenue minus your direct cost. And then you minus your depreciation and amortization. Okay, this items is depreciation and amortization. Okay, sometimes we call it depreciation and amortization, D&A. So the amortization and depreciation is calculated based on the life cycle of that asset. So your gross profit minus your depreciation and amortization. Okay, here you're supposed to have one is called EBIT. Okay, this is a EBIT DA. Okay, is called earnings before interest and tax plus depreciation and amortization. Okay, you have this one equal to EBIT DA, EBITDA. So the EBITDA minus your selling and administrative expenses. Okay, selling and administrative expenses, that will give you operating income. So what is operating income? Operating income is your earnings before interest and tax. Also, we call it EBIT. So the EBIT minus your interest expenses. Okay, this part is going to be, you see the EBIT, you pay of your interest expenses, so the I is removed. So that is income before tax. So the income before tax is also called earnings before tax. Okay, earnings before tax. So this one equal to earnings, okay, EBT, earnings before tax. Okay, so the income before tax is also earnings before tax. So they are the same thing. And then you exclude the tax, income tax. So the income tax is going to be a percentage. Okay, let's say 25% of your EBT. Okay, the income before tax minus the tax rate times your income before tax. Okay, that will give you the net income. Okay, net income. So the net income is going to be your equal to your EBT. Okay, earnings before tax. Okay, times 1 minus the tax rate. Okay, the T is a tax rate. So 1 minus tax rate times earnings before tax, that will be your net income. So sometimes the people ask you, you have your own business, what is your profit? What is your company's profit? So it's hard to answer that question because you see the profit including, what do you mean profit? It means gross profit, operating profit, or net profit. Okay, you can use profit or either income. You can say, okay, what is your gross income, operating income, or net income? Okay, either one, yeah. So the income is or is profit. So the income is going to be calculated based on this income statement. So you set net income divided by the total number of common shares outstanding. Okay. For example, this company in that example you have 4,117,000 shares. Okay, this is a total number of shares outstanding, and that is your net income divided by this total number of shares outstanding. So we have the earnings per share. So earnings per share. Okay, earnings per share. As the earnings per share is your net income divided by the total number of shares outstanding. Okay, that's going to be your earnings per share. So it's very important. So when you see that the common stock dividend paid, so you have retained earnings, minus your stock, the common stock dividend paid, that will be the change in your retained earnings. Okay, change in retained earnings. So the retained earnings is what is retained earnings. If, for example, your company, you generate 4,170 US dollars. So what are you going to do with this money? Okay, what are you going to do with all this amount of money? Okay, what you're going to do is that this much, and then you could do two different ways. Okay, one is goes to the retained earning. So you keep this part amount of money in your company. Okay, this is the money is going to remain, or you keep this amount in your company, and this amount is 400,000, right? The 400,000 is not going to keep. It goes to your stockholder. The money distributed to your stockholder is called dividend paid. So you pay your owners or the stockholders for their investment. So the net income basically used for two purposes. One, either you keep in your company, or either you reward your stockholders or owners. Okay, so that's what we talk about a income statement. So the income statement is very important. Is that so you can see the first is that is a ended December 2014 for the year. So it's going to be a period of time. Of your total revenues and total expenses, or those revenue or expenses items, or different revenues expenses items. That is your income statement. Okay. Next is going to be what are we going to do is talking about the balance sheet. Okay, next we talk about the balance sheet. So the balance sheet, you always have to use the this is called a balance sheet equation. So the company, they have the balance sheet classified as asset category, and another category is liability and owner's equity. So let's see the balance sheet of that asset and the liability. Okay, so the asset side, so you will see we have the total asset equal to total liability plus owner's equity. So the asset side, you will see you have current asset. So the current asset part is going to be, this asset is pretty liquid. Usually they have maturity no more than 1 year. So it's a current asset, we call them working assets. Okay, so working capital is less than 1 year. Most of the time, less than 1 year, or one operating cycle could be greater than 1 year, but if it's a less than one business operating cycle. And the first item you can see in the current asset item, you have a cash and you have inventory. And then you have accounts receivable. And also you have some, this is called short-term investment. Okay, you have a short-term investment. Okay, short-term investment. That's also short-term investment. And also you have the fifth is more likely most of the time we call the prepaid item. Okay, so you have prepaid item. You paid in advance. Okay, this is the asset. And other than the current asset, you have a fixed asset. Okay, the fixed asset part we call land, plant, equipment. So it's going to be, we usually use a property, plant, and equipment. Okay, this is called property, plants, and equipment. So most of the accounting textbook you can see they talk about property, plants, and equipment. Remember that fixed asset is long-term, okay, usually more than 1 year. So they have their own life cycle. They last for many years. So the asset value will be reducing, okay? It's called accumulate depreciation. So the asset value keep depreciating, okay, reducing. So it's going to have to do the depreciation. So we call sometimes this net present value, and after you exclude the depreciation, it's going to be net fixed assets. And on the Okay, liability side is that, so you will say liability including current liability and a long-term liability. Okay, look at the first one is current liability. Okay, what is your current liability? Current liability accounts payable, and accounts payable are the items you already purchased. Okay, you purchase materials, but you have to pay the suppliers. And this is a accruals. The accruals is going to be like employees' wages, right? Salaries. And the third one is called short-term debt. So also you have short-term debt, meaning like a short-term loan is going to be goes to the current liability. For long-term liability, so long-term liability is that, so those are the debt you're gonna pay off in longer time period for the long term. And then you have a bond, long-term bank debt, mortgages, and a preferred stock. Okay, that's a long-term liability. And the rest is going to be owner's equity. So owner's equity including common stock, common stock, and capital in excess of par, retained earnings, and the money left or the profit you kept in your retained earnings. Okay, the kept in the company. So basically, the asset, total asset equal to your total liability and owner's equity. So you can, sometimes you can just draw a circle, okay? So that's the total is your total asset. So the total asset of the company is going to be like a pizza, okay? And that's your total asset, or the company total asset, okay, total asset. And you could cut that into two slices, okay? The pizza slice is too big, it's not just 8 smaller slices. So you can cut into two slices, okay? The slice, how you cut, is depends on this capital structure. We call this one as the how you cut the pizza. The process is a capital structure, so it uses a liability. So the liability is basically is your debt, the money you borrowed. And this side is your owner's equity. So another side, okay, another slice of pizza is called owner's equity. So the equity is stock, okay, or the debt is bond. So you can see this is two slices of pizza, or that's form your total assets. Okay, so and let me see the picture. So you can have this picture showing your total asset, 54 million, and then you add up your total liability, and this is total liability and a total common equity. So the two numbers you added up is also 54 million. So you can see this is 54 million, right? And this is 54 million. So you have to make it balanced or exactly the same. Okay, so the for the income statement, so you can see income statement you include a revenue part and expense part. So the revenue, for example, your total sales, total revenue, And then you have investment income or interest received or dividend received, or from your capital gains. And for the expenses part, you have the direct cost of goods sold. And also you have to pay the accruals, the people, employees' salaries. And you have a depreciation expenses. Okay, depreciation expenses on your fixed asset, and tax, interest you paid, other expenses, selling, business or administration expenses. So that will give you the net income. So the income statement talking about the revenue and expenses of the business. And so the net income, remember, so how you gonna use that net income? You have two ways to do it. One is distribute to your stockholders as dividend. Another way is keep that money, right? Keep that money in your company. So in that way, that means your retained earnings will change, or changes in your retained earnings. Next we talk about is the statement of cash flow. The statement cash flow is going to talk about the cash flow. Okay, it focuses on the cash flow. So how you know the company's cash flow, or the statement of cash flow. Okay, so the statement cash flow is really important, is your cash inflow minus your cash outflow equals your change in cash. In finance, we focus on the cash flow. It's not going to be accounting profit. So why this is so important? The cash flow is, you can see a lot of business or company, they do have report they have a profit or net income in a financial statement. But when you ask them to show me the money, okay, where is your cash? So they do not have cash on hand or in their deposit. That's going to be a problem, right? So sometimes they talk, they earn a lot of money, but where is your money? Show me that. Okay, they couldn't show you the money. Is that going to be somewhere, something wrong with the company? So we wanted to know the company's financial statement is important. We need to look at the statement of cash flow. Okay, the statement of cash flow is going to be from operating, or from investing, and from financing. So the operating, such as increase in your cash sales, okay, you sell your products, right? So you're supposed to have more cash. And you have depreciation expenses. Remember, depreciation is a non-cash depreciation, right? It's a non-cash process. So namely, you depreciate your products. That doesn't mean you lose the cash. And next one is collection of account receivable. So if your account receivable money, okay, you collect account receivable, that means you will add to your cash, right? Because you collect the money from your account receivable, the customer is going to pay you money. Decrease in inventory. If your inventory decreases, that means either you used for the products, or either you sold the inventory, right? So that is cash inflow. And cash outflow. So cash outflow is the money goes out of your pocket. Payment to suppliers. Okay, usually we're using this one. You can see the cost of goods sold. Okay, cost of goods sold plus the payment to suppliers account payable. Okay, accounts receivable and accounts payable, and the salaries. Okay, accruals. Or you increase account receivable. Okay, you minus increase in account receivable, and you minus decrease. Okay, the decrease in payable. So that's cash outflow. So the payable you can see decrease. So you're supposed to pay that amount, but it decreased, or you decreased accruals. Okay, you already paid the salary. Okay, it's going to decrease your accruals. So the cash inflow, the sum of your cash inflow minus the sum of your cash outflow is going to the change in cash. And the statement of cash flow you have, that is from operating, right? And this category is from investing. So investing mainly talk about the fixed assets. So the sales of fixed assets, cash inflow, and the purchase of fixed assets or other items, cash outflow. Okay, investing is for long term. Okay, and for the, let's say, operation is working capital is a daily operation. Okay, it's short term. The investing is for long term. Usually we talk about fixed assets. And next is a form financing. Financing is going to be talking about either bond or either stock, okay, or capital gains. You sell of stock or issue long-term bond. Okay, those two are the major way that company can raise capital. Okay, issue stock or either issue long-term bond. Okay, debt, long-term debt. Or notes payable. Notes payable is a major term. Usually, we consider notes payable as a long-term investment because most of the notes payable are 5 years, okay, no more than 10 years. And the cash outflow. Cash outflow is, for example, you buy back stock, stock repurchase, buy back stock, repay long-term debt, okay, repay long-term debt, or you pay dividend, pay interest. You pay the dividend or pay the interest. All those are cash outflow. So those cash outflow is going to be excluded from the total of your cash inflow. That's going to be the change in cash. Most important is you can see the dividend, pay dividend. Okay, the payment, pay dividend is our financing activity. It is a activity, financing activity. Okay, so you can see here, so when goes the statement here. Okay, let's see. This is the statement of cash flow. The statement of cash flow is similar to income statement, is that is for a time period, for the period of time, but balance sheet is not. Okay, keep in mind, balance sheet is just the financial condition or position a specific time. Okay, a specific time point is not the financial condition over a particular period of time. So you can see the income statement here. So you have cash from operation, and then you have a cash from investment, and then you have the cash from financing. Okay, the three major categories, and you sum them up. That's your statement of cash flow. Okay, so you can see what we talk about is that based on the financial statement. So the financial statement, they have, we call them book value. Okay, those are the book value. So the book value are recorded in the company's financial statement over that period of time, or at that point of time, that how your financial performance, how your financial position looks like. Okay. On the other hand, you can see the current company's asset, equity, or the liability are changing every day. And you have the market value. Okay, the market value. Market value are determined by the market price of the stock. So you can see the book value is just recorded initially at a cost. However, when the book value is not always the same as the market value. The market value is the market price times the total number of shares outstanding. And so the market value and book value are not always the same. Okay, they are sometimes even quite different. Okay, quite different. So what are the factors determine the disparity between the market value and the book value? And for example, and time since acquisition. Okay, the more time of that acquisition occurs, and it's going to generate more differences. Okay, so we call this one is the window dressing. You know, sometimes the manager they know what is a good time to sell stock, and then or they have more private information they know, so they know how to find a perfect time to do the acquisition or do repurchase or they sell stock, right? The time since acquisition. And also you have inflation. The inflation, higher inflation, okay, is gonna cause more difference. Okay, that's inflation. And the third is tangible versus intangible asset. So you have intangible asset that will be more different. So the intangible asset including reputation, right? The company's brand and trademark, or some technology. So those will cause a big difference between the market value and book value. Okay, and for liability is that the main factor that determine the difference between the market and the book value for liability of a healthy firm is the time until liability must be paid off. So if you have the debt, you hold the bond, okay, the longer time you hold, the more likely you're gonna experience more high risk, right? So until the debt is paid off at maturity, the market is clear. So the market value equal to the book value. As for the debt, okay, the debt. And the main difference is that well, the debt or all the debt, they have a maturity. Okay, they know when the debt is going to redeemed. But for the stock, that's there is no expiration date. The debt goes to infinite. Okay, it's going to the stock. We consider that stock is going to remain or last forever. So the equity value is the total market value of the equity is the market price per share times the number of shares outstanding. Okay, so the market price per share times the total number of shares outstanding. For the equity, is the book value of equity is only the owner's equity part in the balance sheet, or you're using total asset minus total liability. Okay. So as what I have mentioned is that, so this accounting is the rule, generally accepted. So all the people they use and that accounting information and generate, and then they have depreciation. So accounting depreciation is the allocation of an asset initial cost over time. That's allowable depreciation expense as determined by established accounting rules. So we have a different way to calculate depreciation, and one of them is called straight line depreciation. So the straight line depreciation basically is the asset value divided by the accounting life, okay, with equal amount of the depreciation allocated to each time period, right? So this is the straight line depreciation. Another way we can do is using Marcus. Okay, Marcus is modified, accelerated cost recovery system. This is going to depreciate a lot more at the very beginning. For example, you have equipment purchased for 9,000 and the cost of delivery and an instrument was 1,000. Accounting life is 3 years. So the depreciation over 4 years due to the half year conversion is going to be the depreciable basis is going to be the 9,000 plus 1,000 is going to be the 10,000. And depreciation is the first year 33%. Okay, so that number times 33.3%. And the second year they depreciated 44.5%. Okay, so that's the depreciation. So what type of depreciation method you use is going to affect your balance sheet. So balance sheet, because you can see this is the accumulated depreciation. If you use depreciate more likely your asset is going to be the total fixed asset value is going to decrease, right? It's going to decrease. So when you add those depreciation back to your statement cash flow, okay, the statement cash flow will be bigger, right? It will be bigger. So that's how you handle the depreciation. And next up, we're gonna talk about the tax, the corporate tax, income tax, and also the inventory. Okay, the inventory, first in, first out, last in, first out, right? So that's what we learned today. Hope you have a good week and stay warm.